Title: The Macroeconomic Ballet: Unraveling the Impact of Inflation and Unemployment on the Bond Market. Introduction. In the intricate dance between macroeconomic factors and financial markets, the bond market emerges as a sensitive barometer, attuned to the nuanced fluctuations of economic indicators. Among the myriad macroeconomic variables, inflation and unemployment stand as formidable protagonists, exerting profound influence on the dynamics of the bond market. Understanding the interplay between these economic forces in the bond market is essential for investors seeking to navigate the complex terrain of fixed-income securities. Inflation's overture. Inflation, the relentless rise in the general price level of goods and services, casts a long shadow over the bond market. As inflation accelerates, the purchasing power of a currency diminishes, eroding the real returns on fixed-income investments. Bond investors face the specter of receiving fixed interest payments that may be insufficient to keep pace with the rising cost of living, resulting in diminished real returns. Consider a scenario where inflation is soaring at an annual rate of 5%, and an investor holds a bond yielding a fixed interest rate of 3%. In this case, the investor experiences a real loss of purchasing power, as the bond's nominal yield fails to compensate for the inflationary erosion of value. The bond market, inherently sensitive to inflationary pressures, may respond with a decrease in bond prices, reflecting investors' demand for higher yields to offset the corrosive effects of inflation. Interest rates and inflation expectations. Central banks, as guardians of monetary policy, play a pivotal role in shaping inflation expectations. The bond market closely monitors signals from central banks, especially regarding interest rate decisions and inflation targets. When central banks signal an intention to raise interest rates to combat inflation, bond yields may rise in tandem as investors seek higher returns in anticipation of tighter monetary policy. Conversely, a central bank signaling a dovish stance, perhaps by keeping interest rates low to stimulate economic activity, can lead to lower bond yields. Investors, in this scenario, may accept lower yields in the short term, prioritizing capital preservation over higher returns amid a low interest rate environment. Unemployment's pas de deux. The dance of macroeconomic factors extends beyond inflation, with unemployment playing a crucial role in influencing the bond market's choreography. High levels of unemployment can signal economic distress, potentially leading to reduced consumer spending, lower corporate profits, and, consequently, the heightened demand for the safety of bonds as a risk-averse investment. Consider a period of economic recession where unemployment rates surge. Investors, seeking refuge from the volatility of equity markets, may flock to the relative safety of government bonds. This surge in demand can drive up bond prices, causing yields to decline. The inverse relationship between bond prices and yields reflects investors' preference for the stability of fixed-income assets during periods of economic uncertainty. Government bond issuance and fiscal policy. The bond market is intricately linked to government fiscal policy, especially during times of economic downturns. In response to high unemployment and economic challenges, governments often implement expansionary fiscal policies, increasing public spending to stimulate economic growth. However, this entails the issuance of government bonds to finance the fiscal stimulus. The increased supply of government bonds can exert upward pressure on bond yields, as investors demand higher returns to compensate for the greater supply of securities in the market. This dynamic showcases how macroeconomic factors, in this case, unemployment and fiscal policy, can directly influence the supply and demand dynamics within the bond market. Credit quality and economic conditions. Beyond government bonds, the bond market encompasses a spectrum of fixed-income securities with varying credit qualities. In times of economic prosperity and low unemployment, corporate bonds may thrive as companies generate healthy profits and exhibit strong creditworthiness. Investors, confident in the stability of these issuers, may accept lower yields on corporate bonds. Conversely, during economic downturns and elevated unemployment, concerns about corporate solvency may prompt investors to demand higher yields to compensate for increased credit risk. The bond market, attuned to shifts in economic conditions, responds by adjusting prices and yields to reflect the evolving risk landscape. Global economic interconnections. In an era of globalization, the bond market is not confined by national borders. Interconnected global economies mean that macroeconomic factors in one country can reverberate across international bond markets. For example, a surge in unemployment in a major economic powerhouse can trigger a flight to safety, leading investors worldwide to seek refuge in government bonds, causing yields to decline globally. Conversely, economic resilience in one region may attract international capital, influencing bond yields as investors diversify their portfolios to capitalize on opportunities in stronger economies. The bond market, in this context, operates as a dynamic arena where the interplay of inflation and unemployment extends beyond domestic considerations, shaping investment decisions on a global scale. Conclusion. In the grand ballet of finance, the bond market twirls and pirouettes to the rhythm of macroeconomic factors, with inflation and unemployment playing pivotal roles in this intricate choreography. Investors, armed with an understanding of how these economic forces influence bond prices and yields, can navigate the fixed-income landscape with acumen and foresight. The bond market, as a reflection of economic conditions and investor sentiment, remains a captivating arena where the macroeconomic forces of inflation and unemployment converge, shaping the financial future with each nuanced movement.